welcome back again to another video lecture from www.enejca.com. This is the second lecture on the series for IFRS 2 share-based payments. For service expenses of some employees. This lecture is for service expenses of employees. As we know, share-based payment can also be provided to employees of any company. This is done only to ensure that the employees stay in the company for a longer period of time. For example, employees need to stay in the organization for a specified period of time. For example, we take 3 years. This is the condition. So we can retain the key employees of the company. If they stay in the company, then all the employees will be able to buy 50 shares, each at a price of 7 per share. So that is the exercise price. Current share price might be lower and is always lower because these shares are issued at cheaper prices. So in this example, current share price is 10, exercise price is 7. So the intrinsic value, current share price minus exercise price, is 3. In this company, there are 150 employees, for example. Alright, using Black and Scholes model, we can find the fair value of the option. And that fair value will be different from this intrinsic value. But we don't need to find fair values, as this will be provided to you in your exam question. It's an equity settled payment, and to calculate the expense to the company, we need to know the fair value of the option on the date the company is providing the option. This date is also known as the grant date. And while calculating this type of payment, we always need to know the fair value of the share option. Alright, so fair value of the share option at the grant date will be given to you in the examination, so do not get confused with the share price. Never use a share price in this type of questions. The examiner might confuse you by giving share price at this date or any later date, but do not use them. The other most important factor to consider is the vesting period. Do not get confused with this thing. This is the period for which is needed to settle the condition. In this case, you need to wait 3 years. The employees must wait 3 years. So that is the condition. So that is the vesting period. That is the settlement period. So 3 years is the vesting period. Now the fair value at the grant date is $6. The calculation will be as follows. Vesting period is 3 years. Fair value of the option is $6. Number of employees at the beginning is 150. Number of shares offered per head is 50. Estimated levers over the vesting period over the whole 3 years is assumed at the end of first year is 30 people. So the expense to the company for the first year will be 6, which is the, let's look at what is 6. 6 is the fair value of the grant date. 50 is the number of shares offered per head. Into persons remaining in the company. 150 was the total number of employees, and we are expecting 30 people will leave. So they will not fulfill the condition and they will not take this benefit. And prorated for 1 year, first year 1 by 3. So your expense will be debit 12,000. Share issuable. Share issuable will be credit 12,000. So this was all for today. Hope you understood this video lecture. Please log on to www.enejca.com for further video lectures. We will be bringing new lectures now and then. So this is Zakaria taking off from Image TV. Thank you very much.